hope you're doing well. In today's video, I would like to answer some of the questions that I have received through various social media platforms. So the first question is, what is my view on efficient market hypothesis? So to answer this question, I will first try and answer what is the efficient market hypothesis. So the efficient market hypothesis basically states that at all given points in time, the market has all information related to a particular security, and that information is factored into the price of that particular security. In other words, knowledge or information over the market is not a reasonable edge. That is, you can, no matter how closely you track a particular security or an economy, you cannot have knowledge greater than the market. And whatever is your understanding, it is already adequately factored in the price of the market. Therefore, proponents or believers of this theory maintain that it is impossible to make money in the markets over the long term. So the question is, what is my view on this theory? So I agree that knowledge is not an edge. However, I disagree that it is impossible to make money in the long term. The reason being that in order to make money from the markets, your edge needs to be over the market participants, as you can never really have an edge over the markets. The markets are perfect and efficient, and therefore competing against the market is not a reasonable plan. Rather, you simply have to take reasonable steps that increases the differential between you and an average trader. I hope this answers the question. The next question, which is more important, fundamentals or technicals? So for the purpose of convenience, the lazy mind has a tendency of polarizing a subject. It becomes very easy to bifurcate the world into right or left, good or evil, black or white, fundamental, technical, and so on, and say that one is better than the other, or that the other has absolutely no efficacy in the overall result. The answer, however, is that in the long term, you as a trader will rely on both the fundamentals as well as the technicals. As a trader, I have learned to believe that the fundamentals of a particular security remain constant for a certain period of time, and that these fundamentals are effectively captured in the security's price. Since the study of technicals is a detailed study of a security's price, technical analysis is simply another method to study the fundamentals of a security. Using technical analysis along with components of money management and trading attitude and behavior creates what is known as a trading system. So a trading system need not necessarily have either fundamental or technical, but will necessarily have some part of it. Therefore, the answer to the question is both are important, and technicals are important in deciding the specifics, that is what to do in the next trade sessions. Next question, indicators versus price action. So there are several students in the market who have again polarized the study of technical analysis into two categories. One, which uses indicators as a tools to either filter or to take an entry or exit into a particular security, and the other group which does not use these indicators in order to take a trading decision. Often, these students advocate superiority of one method over another. I think this discussion is redundant because the best trader in the world would know every indicator that is to know. And therefore, if you as a student aspire to be a better trader, having not just a bare minimal working understanding, but a detailed understanding of all the commonly used tools in trading framework is a bare minimum requirement. Therefore, we, for the purpose of this discussion, will assume that indicators are just another method of representing price, and that it is a visual method of seeing certain changes in price that might help us filter and potentially take better decisions. I personally do use indicators in my own trading decisions. Next question is trading as a career and trading mindset. So, trading as a career needs to be taken by people who have a healthy balance sheet. The question is, what do I mean by a healthy balance sheet? So, here basically I have clustered categories of people A to G, where individual A is a person who has no assets, who has an ongoing liability such as a business loss, a personal loan, a medical loan, a disabled family member, and so on, does not have any income sources. And to such a person, whom we would ideally advise to file for bankruptcy, should not pursue trading. Similarly, when we look at category B, where the individual has some assets, such as the individual does own a house, but the individual also has liabilities, such as the house ownership is accompanied with a home loan, or a student loan, or an ongoing medical loan, or a personal loan, with no real income source, such as the individual could be a retired personnel. Such individuals who have such a poor balance sheet should also not take up trading. We then look at the next category, where an individual has ongoing assets, has liability, and an income sources. Such an individual should not take up trading until they square off all ongoing liabilities. Trading finds a role only when the requirement is to create multiple income sources. That is, we are looking at category E. In other words, we are looking at individuals who have assets, who have a few income sources, may or may not have liabilities, and are now looking to create multiple income sources. Such individuals could consider trading as one of the multiple income sources at their disposal. Individuals who are below this segment should avoid considering trading as a full time career, and rather, if they truly enjoy the markets and trading, they should try and build a career maybe in the financial services industry instead of relying on trading as the only income source. Therefore, trading as a career is best for individuals who have secure income sources prior to taking up trading as a career, and that trading as a career has its true utility when the individual is in the process of creating new income sources which may be required for the household at that time. The next aspect is the trading mindset. The trading mindset essentially is a prerequisite to everything that you do in the market. For example, the mindset of a trader who is writing options on an intraday is completely different from the mindset of a futures trader who's carrying forward positions indefinitely. The person who's writing options intraday has this incredible requirement of earning money daily and to be correct most of the times. Whereas an individual who is carrying futures for multiple trade sessions has this requirement of capturing speculative moves. These are two structurally different approaches in the market, and they are captured by the difference of positions that these traders take. So, trading mindset is not an intangible um, is not an intangible, hard to realize concept, but rather that aspect of trading that is visual at every aspect of trading. So, for example, if we look at the current positions just a minute before the market close or the market has just closed, you will see all the positions are futures and all of them have been carried forward. In fact, ICICI Bank and HDFC Bank have been carried forward since July series. This is an indicative of a trader who's chasing speculative growth. This is very different from traders who write options. The temperament, the mindset, and the process of decision making for such a trader is very different from, say, an option writer. Therefore, the trading mindset needs to be evaluated in greater detail, and one of the best methods of doing this is to analyze the data of the trader based on the trades that they have currently undertaken. And the last question, tips for becoming a better trader. So be true to the concept that you're trading. If you're taking up a trade because it is trending in nature, you have to be able to follow the trend till it bends. If you're taking a trade because it is ranging, you have to take the security range at the pivotal high or low, such as a double bottom, double top, or some point in the trend line intersection where you take targets. You have to trade based on the pattern or the trend that you are seeing, and you have to only trade those securities which meet those criteria. Making profits without keeping a stop loss is a setup for destruction. So, if there is something that you must do, it is to enter a hard stop loss every time you take a trade. Having a pre trade and a post trade ritual is also very helpful. While trading, you want to be in the area of known and familiarity. Everything you do should be comfortable and should be known to you. You should avoid getting yourself into situations where you feel external performance pressure. Therefore, traders who have had 1 or 2 years of profitable run should hold on for some time till they go ahead outside in the market asking for money to manage. As a young trader, it is your responsibility to protect yourself from external influences that could stunt your growth. Core focus of growth as a trader should start somewhere from the 5th to 6th year. You can never overlook the role and importance of research and development in your own trading. Do not underestimate the impact of system failures in your own trading. Do not underestimate the role of your health and other requirements in your life in your own trading. Maintain an intensity that you can sustain for a long period of time. Each of these points, in my view, are important, and during the course of our discussion, I will elaborate on some of these points. I hope you have a good trading week ahead. Wish you best. Have a good day.